Hi, I'm John with Tax TV, here to discuss some of the tax implications of an Internal Revenue Code Section 1031 like-kind exchange. If you sell your business or investment property and you have a gain, generally speaking, you have to pay tax on the gain at the time of sale. However, for certain types of property, Section 1031 provides an exception and allows postponement of paying tax on the gain if you reinvest the proceeds in a similar property as part of a qualifying like-kind exchange. The benefit to a Section 1031 exchange is the potential elimination of taxes due on the sale of qualifying properties, and by deferring the tax, you have more money to invest in another property. While 1031 exchanges are common in the real estate industry, 1031 exchanges are not limited to real property and can be applied to exchanges of any property that is held for productive use in a trade or business or for investment. An exchange is referred to as multi-asset when it includes both real and personal property. Both the relinquished property and the replacement property must meet certain requirements. They must be similar enough to qualify as like-kind, meaning the same in nature, character, or class. The quality or grade doesn't matter, although the objective with the 1031 exchange is that you're not really ending the investment. But there are certain types of property that are excluded from Section 1031 treatment, such as inventory or stock in trade, stocks, bonds, notes, or other securities or debt. The like-kind exchange under Section 1031 is tax-deferred, not tax-free. So when the replacement property is eventually sold, the original deferred gain plus any additional gain realized since the purchase of the replacement property is subject to tax. Likewise, any gains can be reduced by losses from the future disposition of the replacement property. To qualify for a Section 1031 exchange, an owner, who may be an individual or a business such as a C corporation, S corporation, partnership, limited liability company, a trust, or any other tax-paying entity, may set up an exchange of business or investment properties. The types of exchanges are a simultaneous exchange, meaning occurring at the same time, a deferred exchange, with the replacement property being purchased shortly after the initial sale, and a reverse exchange, with the acquisition of the replacement property occurring prior to the sale of the first property. A qualified accommodator must be used for deferred or reverse exchanges. There is a time limit of 45 days after the relinquished property is transferred for the taxpayer to identify a potential replacement property, and there are no extensions available. The exchange must be completed within 180 days after the transfer of the relinquished property. You must report a 1031 exchange to the IRS on Form 8824 and file it with your tax return for the year in which the exchange occurred. It is important you specifically follow the rules for like-kind exchanges, or you may be held liable for taxes, penalties, and interest on your transactions. For more information relating to the Section 1031 like-kind exchanges, check out taxtv.com.